What is up, guys, and welcome back to another Crypto with Leo YouTube video. Now, today we're going to be going through a topic which has been very much demanded by you guys, that being crypto market cycles. Now, in this video, I'm going to run through quite literally everything you need to know, taking you through psychology, some catalysts that we have coming up that are going to feed into this, and understanding the market cycles in general and relating it to what we're currently seeing. So before I even get started, let's jump straight over to see where we are. I mean, right now on the charts, like we said, I gave you basically a little insight into what I was thinking from a TA perspective, and we've seen it play out beautifully. That being a slight pullback from Bitcoin, and it's now taken off, and we're jumping into new all-time highs. Now, what we're really seeing is this ripple into the rest of the market. As you can see, many coins are sitting in comfortable percentages. Bitcoin at about 67.5K. I think we saw it tap all the way up to, look at that, it was around 68K, which is absolutely awesome. Ethereum sitting comfortably at all-time highs, and we all know what happens after that, and it is starting to relay into the alts. Solana sitting very comfortably 20% for the week. XRP had a very nice run for those that were watching that, and this will continue to happen. Now, what I do expect, and I want you guys to understand, is that Bitcoin is eventually going to take control of this and have a huge push. Now, I do expect we might see a slight pullback before this happens. However, you have to understand, when Bitcoin does do this, it will soak up volume, soak up liquidity from the markets, and in turn, something we can call bleeding alts. And what this means is it's going to take liquidity out of alts, take volume out of alts. We might see slight stagnant, although at slightly raised prices. Now, another thing as well, I think, as the media is playing its part now, we're going to see a lot of retail money start pushing into the market as Bitcoin starts pushing to all-time highs. Because what better time to get the retail into crypto than when everything's creating new all-time highs? You know, they're going to come on with a sense of euphoria, enthusiasm, thinking this is going to go on forever. I'm going to be so rich, and I'm the cleverest investor that has ever lived. They're going to relate themselves to Warren Buffett. Little do they know we've been in since, 80, 90% discounts. Anyway, as we move on, I'm going to jump straight into probably the most important topic one of the most important topics that I'll run through on this page, and that is crypto market cycles. Now, what is a crypto market cycle? Now, these are not just to do with crypto. These can relate into any market. Every market has a market cycle. Market cycles happen in all financial markets, as I just said. It is a natural procession of cycles that are bound to appear and reappear as time progresses. For example, we see in crypto, market cycles heavily align with a Bitcoin halving, hence why they happen every 2, 3, 4 years. So what we saw 2017, and then the Bitcoin halving happened in 2020, and that was pretty much when this bull market really started kicking off, was through 2020 all the way through 2021. Now, a market cycle is the period between a high and a low, and more broadly, the stages in between. Now, I'll show you this quite literally on the charts after this slide. Now, given the speed and volatility of the cryptocurrency industry, having a strong understanding of the market cycle is an invaluable lesson, and that is something I cannot relay onto you guys enough. Now, right here, I've compared all three bull cycles that I can pretty much from a chart perspective. So we look at the 2013 market cycle. As you can see, we see the low, we see the high, and we see the low. The market cycle is everything that occurs in between these points. Now, what is really interesting as well, guys, is what I'm going to look at in the charts later, is actually how dates of these market cycles strangely align. And this is why, and it highlights the importance of being able to utilize historical data. And I hope that's something that you guys can take away from this video and learn for yourself, is the ability to go back, look at historical data, and somewhat give you a picture of what we could see happening. That's why I've been saying for so long, Q4 is going to be extremely bullish, because what happened here in 2013, Q4 was extremely bullish. Now, same again in 2017. Are you already seeing similarities, guys? Look at the charts right here. You see this slight spike up, a dip back down, strangely enough. In the same time, we saw a dip back down this cycle, and then we saw a huge parabolic push in Q4. Once again, we see a slight dip down and a huge parabolic push in Q4 in 2017. Now, although that is pointed down there, this was actually the pullback which we have seen this year, as in these timings matched up perfectly. Now, once again, market cycle is everything that happens in between the low, the high, and the low. And this was the all-time low. Now, 2021 market cycle, and this is pretty much, so basically where we are now. And I've put up here so far, sorry, it's covered by my face, not the worst thing. So this is so far what we can see. This was the low basically prior to the start of this bull run. This was around 2020. And then we've seen it go all the way up through the first half of this year, huge parabolic gains, all the way up to new all-time highs, sitting at around 64,000. Now, as you can see, guys, we're comfortably sitting above that now, although this is the chart from yesterday when I created these slides. But what you can see, guys, is from 2013 and 2017, massive similarities. And I'd like to show you how the dates actually line up as well. So if I do go back in time here into, 2013, you can see right here, the peak of this was at the 25th of November in 2013. 25th of November. Remember that date, guys, because as I jump through to 2017, sorry, the next bull run, the peak was on the 11th of December. So you can see they're literally a month in between each other. And I'm pretty sure they get even closer when I go on to a different time frame, but I'm not going to do that. Same with the lows, guys. As you can see here, from 2017, the all-time low was around $3,000. Shout out to anyone that got in down there. And as you can see, the date that occurred was the 10th of December, 2018. So pretty much a year after we had reached all-time highs. Now, what happened in 2013? Once again, you see 25th of November, we reach all-time highs. I mean, you can see again here, it's December is matching up with it as well. And then the all-time low after that, down here, was literally pretty much a year later again. So once again, you can see how historical data lines up. The highs of both bull runs lined up and the lows literally lined up perfectly as well. So that's pretty much how you can utilize historical data. And it's what we're seeing going forward. This is how we knew, because this high, I've been saying this majority of the year, this high occurred in April this year. And I knew when we had this massive dip, when everyone was stuck in a bear trap down here, oh, we're going to go to 10K, this bull run could be over. And I was saying, no, historically, this is not proven to be over. We have a lot more to come. This blip right here, you can relate to this blip right here. Now, whether we're going to see gains like this again, well, that's what we're excited to see, guys. Now, as we move on through this slideshow, market cycle psychology, this is probably a really important aspect. We've looked at a TA perspective, how you can relate previous market cycles to new ones. Now we're going to take you through the psychology of a market cycle. Massively important. Now, as you can see here, we have four phases is what we call. We've got phase one, which we're going to run through, phase two, phase three, and phase four. And as you can see, optimism lines up on both sides because it isn't a never-ending cycle. Optimism is the start and the end. Okay, that's how you can line it up. So why do we need to learn this? Why do I need to know about market psychology? Anyone that's got into crypto, you understand the volatility of it, so you can understand that or get the toll that can take on you psychologically. At the end of the day, you're investing your money, your capital, your hard-earned capital into this market, and to see it fluctuate, these huge 30, 50% fluctuations, that can take a toll on your psychology and will do for anyone. So what this will do is help you recognize that a lot of investing decisions are often driven by emotional reactions rather than rational calculations. And that's what I want you to take away from this. I want you to take away from this the knowledge that you can then go forward and implement rational calculations into future investments and hopefully help you take advantage fully of the bear market coming up. Now, being aware of these cycles and keeping your own emotions at check is one of the key elements that will lead you towards being a better investor. 100%, guys, completely agree with that. Really listen up and follow through with this. A lot of people are making a lot of people make a lot of money in these markets, and that goes without saying, okay? However, not a lot of people actually leave these markets with the money. In other words, these are unrealized gains. It's all great seeing it on your in your portfolio, seeing your gains, seeing your portfolio jump up hundreds or thousands of percent. However, how many people actually realize those profits? And that's why it's so important to have an exit plan, which is what I'm going to make a future video on for you guys. Now, let's just jump straight into it. Phase one, optimism. Now, you've already saw where that starts. Typically, investors enter the market with optimism, which is why it's found right at the start of the emotional cycles. Now, I'm going to jump back quickly because I want to highlight this to you. This is where retail investors are going to enter the market. And as you can see, they're entering it late. If you get in a bear market, you're here, right down here, point of maximum financial opportunity. When there's most fear in the market, that's when it's time to be greedy. And that's why despondency is so important to jump in. Have a retail investors through media narrative, everything being pushed out, they're jumping in around relative all-time highs, which is what we're seeing right now. They're jumping in at optimism. So As humans, we generally expect things to go our way, or that we will most likely be rewarded for taking the financial or taking the risk of investing. In other words, these guys are going to jump into this market. They're going to think they're early as ever, and they're going to think, I'm going to be rewarded for this, you know? And this is why we enter into the markets, because we believe that by doing so, we will be able to increase our wealth. Now, reality is a lot of people will be able to still increase their wealth, not to the gains that we're getting. However, they will be able to be getting in and, you know, somewhat 1xing, 2xing, etc. The problem is, however, is how many of them are going to realize those gains and emotionally, psychologically think to themselves, oh, I could do more. Why would this bull run end? You know, it's already going up. The media's talking about it. Freaking hell, the Bank of America just said they're going to adopt it. You know, all these things are going to start coming out. Now, phase two is or still in phase one, excitement, the second stage of it. Now, this is when your investment starts to move in the direction that you would like it to. Now, we'll get enthusiastic about the prospect of even greater profits. At this point, you know, your profit, you're sitting comfortably in profit. You know, your initial investment has doubled, etc. And all you can think about, because it's a normal thing for humans and psychology, is I need more. This can go for more, and that's what leads into thrill. As the moment strengthens, we become captivated by the experience and begin to anticipate even greater results. Confidence is building. Now, this is such a dangerous point in the market, guys. And it's the whole point of having an exit plan in place, is understanding your take profit levels. If you do not, you're going to get attached to the monetary figure sitting in your portfolio, and you're only ever going to think that's going to increase. Now, when a bear market hits, which inevitably will, you know, your portfolio is going to take a hit if you never realize your profits. Now, phase one, still, and it's euphoria. This is literally the peak, and it is extremely dangerous. Investors may experience euphoria as the market reaches the top of its cycle. This is when we're sitting at all-time highs. And, you know, at this point, all these retail investors that got in relatively late, they are thinking, oh my God, I timed this perfectly. You know, I got in and it's just only gone up. This is going to continue going. Why am I going to take profits? You know, I put in £1,000. It's now sitting at 2,500, 3,000. This can easily go to 10. But it's all that. This is the thing. Never relate it to figures. You want percentages and take profit levels. We begin to believe that investing when we did was a genius decision, and we believe that the bullish market will continue to grow exponentially. During this phase, we may even delude ourselves into theorizing we can handle higher risk. In other words, they can start thinking, I've already doubled my money. Why don't I just put more in? Leading us to add more positions or invest into higher risk assets. This means jumping into low caps that have already done, you know, thousands of %, and they think, oh my God, this is the next big thing. Now, phase two. Now we're jumping into phase two out of phase one, which is excitement, enthusiasm, thrill, etc. Now it's phase two. This is where it gets a bit scary. Denial. When the market begins to turn, the cycle enters the second phase. This is after, you know, we may have seen the top of it or an all-time high, blow off top. Firstly, we wait with eager anticipation to see if the slowdown is merely a bump in the road. We may believe that it will get better soon, and as a result, we will continue holding. In other words, you know, it may have taken a 20, 30% dip from its all-time high, but you think, no, this is normal. It's going to carry on. It's going to go on forever. Hence the name denial. You do not want yourself to believe that it is the end. Anxiety. Denial takes a backseat to fear as the markets continue to fall. This is when we're going from 20, 30, 40, 50% drops. Investment values may fall, and the realization dawns that we may not be the top investor we once thought we were. Fear. Now, when market losses continue, genuine fear begins to emerge. Some investors may even take a defensive stance, shifting/liquidating their investment away from the assets to protect their capital. Now, I did this point at the end because it's really important. This is when supply of assets begins to outweigh the demand, and the market begins to really, really fall. Now, this is when you start seeing the 80%, decrease in value of a majority of assets in a bear market. That's because of driven purely by fear. And all these people, are just flooding supply back into the markets, and the demand isn't there to pick it up. Okay. Phase three. So now we're out of phase two. Phase two has been terrifying. It is when retail, investors, at this point, you will hear this saying, and they'll go, crypto is a fad. Crypto is fake. It's never going to be anything. I've lost all my money, blah, blah, blah. And, you're going to get a minority of those people that are going to think, no, this is the future. I'm going to start doing research. There's opportunity to be made here. And those are the people that are going to profit in the next cycle. Now, phase 3 is depression. The possibility of a bear market becomes evident in this third stage of the cycle, and investors may become depressed, and this is the thing. It's an emotional and, psychological impact of investing your capital. The attachment a lot of people have is crazy. And investors may become depressed over fumbling their opportunity and desperate for profits. In other words, they fumbled their opportunity to take profits at the highs because of greed. Now, greed is completely normal, guys, and they're desperate to make more profits. Now, phase 3, panic. Many missed out on the opportunity to take profits off the table. They may try regaining what's left of their capital by selling their investments that have now returned back to where they initially invested, or worse, have moved into a loss. So these are people that, at this point, they have no faith. They thought this is all fake. How can a functional market fall 80%? Now, don't be that person selling at a loss, guys. And I say this again, remember, it's only a loss once you realize those, when you realize it, pretty much. And especially in something like crypto, I say this so much, guys, day-to-day price action does not reflect onto an asset's fundamental utility. At the end of the day, an asset's future is not deemed by its current price. Okay. Look into partnerships, look into the team behind it, look how long they've been around, look where it's being utilized. Those are the things that should deem something's value. Don't get drawn into, day-to-day price action. Focus on the long game, especially with crypto. We are so early. Now, capitulation. This leads perfectly on from panic, as you feel like you're at the mercy of the market at this point. You're completely out of control at this point. You might have even lost connection to that, your initial investment. You might just be thinking to yourself, you know what, let the market do its thing. At this point, there's no point taking a loss. Now, some people will pull out completely in this point, abandoning investments at precisely the wrong time. They will have in their mind, if they sell now, they can re-enter at a lower price. Now, what does that link into again? Greed. Now, despondency. Those who didn't take profits and stayed involved could start to feel disheartened and seriously question if they should have ever placed their money into the cryptocurrency market. Phase 4, skepticism. When markets begin to rise in the fourth phase of the cycle. Now, remember, at this point, we've gone through phase 1, reaching the peak. Phase 2, when we start heading into a bear market. Phase 3, which is sitting at the lows of the bear market, where the maximum psychological impact is happening. However, that is pretty much where you can maximize your financial gains if you know how to take advantage of it. And I want you guys to take that away from this. And phase 4 is when we really start picking up again. Now, when the markets begin to rise in the fourth phase of the cycle, investors may be apprehensive. At this point, you are so beaten up psychologically that you're just thinking, do I want to put more money in? What if we dip further? Remember, day-to-day price action does not reflect on something's fundamental utility. They will feel hesitant or concerned about whether the market's growth will continue. Pure hesitance, you're apprehensive, you don't know if it's going to go back up again. Hope. Investors are beginning to feel optimistic about future market gains. However, may still be afraid to invest money. Once again, as I said in the previous slide, even if prices are still extremely low and opportunities are attractive. Guys, as I said, it's in a bear market where you have the maximum chance to make financial gains, change your life. I'm not even joking. Now, phase 4, relief. Investors begin to understand that the market is bouncing back. The market cycle can start all over again for investors who let their emotions rule their previous investment decisions in the last cycle. Guys, and that is pretty much it. And what do we go back to after relief? Guys, after relief, it takes us all the way back to optimism, straight back over here. Can you see how it is a cycle? It's just a wave, and it takes us straight back into optimism, and it all starts over again. And that is the beauty of a market cycle, guys. And it's understanding that is going to help you guys make the maximum financial gains. Now you understand market cycles, you understand the psychological impact of market cycles. Now let's look into some catalysts that I see coming up that are going to be absolutely huge and play a massive role. And I will be making a video on these. Now, here is a current list, and a key date to look out for, guys, coming up before I end this video is the 14th of November, 2021. And this is when we're going to see VanEck's spot Bitcoin ETF either get approved or denied by the SEC. Now, we'll be honest with you guys, it's currently looking a bit more on the denial side. The SEC is not being clear with regulations in regards to spot ETFs. Now, quickly for reference, before I do make a video, spot ETF is Spot ETF is an ETF literally directly backed by Bitcoin. That means it is a one-to-one with Bitcoin. Futures ETFs, which have been approved, are basically priced against future derivatives contracts. They do not match the price of Bitcoin. The beauty of a spot ETF is that institutional investors will quite literally be investing into the volatility of Bitcoin. Okay. And why will institutional investors love ETFs? Because it takes out the risk with security laws. It takes out the hassle with exchanges, which, trust me, it's a hassle when you're playing with hundreds and hundreds of millions, possibly billions. So yeah, but this is what is exciting, guys, is this list right here. Now, as you can see right here, where was it? The VanEck one. As you can see, possible approval date is the 14th of November, 2021. But this whole list is a list of spot ETFs, which we could see. And as you can see, there's a coin-based or coin-backed. Backed by Bitcoin is what that basically means. And I think once we see one spot ETF get approved, guys, it is going to be a ripple effect. And I swear the institutional money that is going to flood in will be in the trillions. Now, this is the thing, whether we see it get approved next week or whether it comes in next year, I'm really going to be interested in watching how that relays and has an effect on price. Anyway, guys, I'd like to massively thank you guys for watching this video. I really hope it's helped out with your understanding of market cycles. Now, remember, this is the key thing. You want to understand market cycle psychology. Please leave in the comments, guys, any other videos you want in the future for me to make. I try and really go into detail and depth and help you guys understand it on a basic level. Furthermore, guys, please subscribe. It really helps out this channel. I've only just started. I'd like to say a massive thank you to everyone that has followed me on TikTok. I hit 100K today. I can't quite believe it. Still, it's a privilege to be able to bring content to you guys. I hope you enjoy it, and I hope you take value away from it. Once again, subscribe, like, share this video to a friend. I'm really trying to get my name out there. Thank you again, guys. Have an amazing rest of your day. Peace out.